Good morning, Vikaash. Thanks so much for taking out time to speak with us. So let's understand first up that how would a REIT inclusion in one of the most prominent indices of the country, enhance visibility, brand recognition, coverage for embassy REITs, and how does it sort of improve investor interest and participation as well? Just get a starting thought, to kickstart a conversation with you.
Sure. Good morning, everyone, and thank you for having me over the show. So as you mentioned, since Embassy REIT got listed in 2019, REITs have now evolved as a mainstream asset class. Just to give you a quick stat, about 16,500 crores have been raised by the three REITs put together over the last 2 years. Now, again, the benefits of inclusion in indices is, from a retail investor perspective, one, it improves liquidity. Two, it helps in seamless price discovery, so there's no potential. It mitigates any potential major price movements. And three, it helps the passive index funds to participate in the REIT story and it helps the REITs to get inflows from the passive index funds. So I think all in all, it helps the retail investors to participate in what we believe is a phenomenal long-term commercial real estate growth story. And we've already seen in our own book at Embassy REIT that the number of retail investors since our listing till now has increased by 3x, and we believe this will increase even further, both with the trading lot size reduction as well as with inclusion in indices. As you rightly mentioned, we've recently been included in a couple of indices, and we think as we move forward, the trend will continue to the benefit of the retail investors.
Okay. What sort of investor participation as well you've seen, because what's interesting about a REIT is that relatively they carry lower risk, because you obviously have to invest a certain amount of your asset pool into securities that do tend to generate good cash flow. Let's not forget, of course, it's commercial realty, so the yields as well are much, much better. So what sort of investor interest you've seen, and let's start with that. Like, what sort of investor interest you've seen? Do you think it's increased over time, especially since you're listing?
Sure. That's a great question, actually. So, just to take a step back, at Embassy REIT, over the last 9 quarters since we got listed, we have delivered a total 34% return, of which about 4,200 crores have been in terms of distributions, more than all the other nifty realty companies put together. So, what we have seen is there's an increased awareness and participation in REIT as a product. We believe it is the right mechanism to participate in the commercial real estate growth story. So whether it is global institutional investors, some of the biggest names we have in our book who believe in the story, who believe in us, to some of the large domestic mutual funds and domestic investors, to now, as I mentioned, the retail investors and the HNIs. So we have seen a mix of participation, interestingly, from all of these segments. And ultimately, any investor who's looking for a total return story, a mix of healthy dividend yield, a majority of which is tax-free. So REITs have the benefit of having tax-free distributions in terms of dividends, and who are looking at growth through multiple levers that we have in our business, for them it's suitable, and it is an essential part of anyone's asset portfolio. Just to give you an example, last year in the middle of the pandemic, in December of 2020, we actually went ahead and raised $500 million to fund the purchase of our Embassy Tech Village asset. Again, so what it does is, we're able to attract these investors who believe in the commercial real estate story. It helps us to grow, gain market share, and deliver those returns that I mentioned about the distributions. We have, despite the pandemic and despite all the pause in decision making, we have laid out projections and guidance for our FY22, so March 22, and we have projected the NOI to grow by 17% and distributions to grow by 11% to about 2,000 crores. Most of it tax-free. So I think, again, that's something which is pretty, from an investor perspective, it's pretty robust. And, we've continued to see interest from all of these categories I mentioned.
That's pretty encouraging, given the fact that, of course, in the last 1.5 years, commercial realty has obviously been in a tough spot, especially if we look at office, I mean, not warehousing or the other segments of commercial realty. So, are you seeing encouraging physical occupancy trends, especially as we just come out of the second wave? Rather, we've been, a month away, things as well have started opening up. So, if you could talk to us about the physical occupancy trends. I know you mentioned roughly a 17% NOI. Could you also give us a guidance for revenues then in FY22?
Yeah, sure. So, revenues, it would be similar trend. What we really focused on is, of course, the NOI as well as the distributions. So as I mentioned, we have guided to over 2,000 crores of distributions, and over 80% of that would be tax-free to investors. So, we believe that's really robust and speaks to the strength of both our portfolio and the REIT as a structure. Coming back to your first question on physical occupancies, we were seeing a good trend on increase in physical occupancies, number of employees working at our parks before the second wave. Of course, the second wave meant that the number dipped. And, at the end of June, we had about 14,000 employees working across our offices across the 4 cities that we have presence in India. Now, again, the stats as of yesterday, we have about 20,000 people working at the park. So roughly about 35% increase from what we saw in the end of June. So the number, the physical occupancies, both in terms of the number of employees, is encouraging. And what we hear on the ground from the occupiers, from our customers, is that they are now, with the rapid scale of vaccination efforts that's happening, they're looking at October to December quarter for kind of ramping up numbers and targeting around 30 to 50%, in the next 1 or 2 quarters. In terms of just occupancy for us at our portfolio level, again, we have been robust, resilient. Our occupancy as of the last quarter stood at 89%. So again, as you rightly mentioned, in the middle of the pandemic, where there's a complete pause in decision making, we were able to both deliver on the distributions and ensure our occupancy stay healthy. And that goes back to our core of product offering and to our core customer base. Over 70% of our core customer base is these large technology companies, including the tech-enabled services and the centers of excellence from these global captives, whether it's the large international banks or global healthcare companies. We have the best names and the global corporations in our portfolio. And, they are in India simply to ensure that they have access to the talent that we have in India. They're not here for the savings in rent. And that is the reason we see robust occupancies, we see robust rent collections, and the NOI growth of 17%, which we're projecting for this year.
Sure. Vikaash, also wanted to understand, just an extension of the point that you were earlier making, what exactly is the timeline for restructuring of Manyata, ETVs, any acquisitions that you may have in the pipeline? If you could just highlight what your own business plans are going forward.
Sure. So, just on the restructuring, we actually completed the Manyata restructuring, and that's why now, the efficiency of our distributions has, been enhanced, further. So now over 80% of our distributions we expect to be tax-free. As you may recollect, dividends distributed by REITs are fully tax exempt, and that's one of the attractive features of REIT as a product. Now, coming to our plans, I'll break it into 2. One is the organic growth plans, and second is the inorganic. On the organic front, of course, the focus is on ensuring we provide all the support to our occupiers. We are seeing early trends of decision-making and deal closures. We are seeing a lot more pipeline than we saw in the last 3 or 4 quarters. And we believe that the leasing momentum will pick up in a couple of quarters from now. We are already seeing some deal closures and site visits happening as we speak. So that's one. 2, interestingly, we have a lot of embedded growth in the portfolio with our existing lease contracts. We have the standard 15% escalation every 3 years that you may be aware of. So this year, about 84 lakh square feet leases come up for rent increase, and we expect about 13% increase in rent on those 84 lakh square feet leases. So, that's a huge opportunity, and we have delivered on that last year. So we continue to believe that all of that we'll be able to secure. The third is, of course, we are currently, as we speak, undertaking about 60 lakhs square feet of new development. we see a tremendous opportunity given supply is already declined, due to the market dislocations, and given the fact that the 2-year forward supply, as estimated by CBRE, is down 25%. So we see a dislocation in demand and supply. As demand, we believe, will pick up to robust levels in a couple of quarters from now, given the increased hiring and the way the technology companies are growing and the deal wins that they're announcing. And on the other hand, the supply is declining. So we see that as an opportunity, and we are building 60 lakh square feet with about 11 lakh square feet we'll deliver this year. So that will add to our top line. So that's on the organic front. Now, on the inorganic front, we did complete about 10,000 crore worth of Embassy TechVillage acquisition in December of last year. We are looking at opportunities. There's a lot of distress in the market right now. At Embassy REIT, we are really focused on quality and really owning the best assets. Again, as a REIT, we are here for the long term. It's a long-term story for us, and we want to ensure we are deliberate, yes, disciplined in our acquisition strategy. Embassy TechVillage, in fact, has helped us enhance both our NOI as well as our distributions to investors, and it has been tremendously accretive. And we are now pursuing similar opportunities of large-scale, high-quality assets, which can dominate the market as we go into a phase where demand returns. We want to own the best assets and kind of increase our market share. Already, we are one of the largest, if not the largest, institutional landlord in the country. So, with both of these plans, we are really positive on the outlook and the long-term story for us. And just to give you a sense on our balance sheet, which will fund both our construction and the organic development, as well as our inorganic acquisitions, we are currently 23% levered on our balance sheet, one of the lowest levels of debt you'll see across the spectrum of the real estate companies. And that gives us a lot of confidence that when a good opportunity emerges, we can really fund those acquisitions and kind of consolidate market share.
Right. Vikaash, great to have you on the show today. Thank you so much for taking the time out and, really highlighting what's happening with Embassy Real Estate, or REIT rather, and what's happening with the real estate sector as well. Good to speak with you. On that